All right, I think we'll get started. Good afternoon. My name is Rich Vandenburgh, the president of the association, and I am moderating today's tax credits seminar. Today we have Katherine VanBramer from Mengel, Metzger, Barr and Company. I've known Katherine for a number of years, and wealth of information, tremendous amount to be learned. So with that, I'll turn it over to Katherine.
Great. Thanks, Rich. Can everyone hear me okay?
Yes.
Okay, perfect. So I'm a partner with Mengel, Metzger, Barr. We've been in this industry for a number of years, kind of growing out. As this industry has grown, we started really with wineries in the agribusiness type environment, but have certainly embraced this industry, and we're excited to be here. We've been allied members for a number of years and excited to talk to you about tax credits. Quick agenda item I'll go over with you guys. So the agenda, we're going to go through some federal tax credits, some specific New York State tax credits, and then we'll get into the employee retention credit, which I'm sure a number of you have filed for, and maybe even more of you are still eligible to go back and amend for. So we'll talk about all of those. Certainly don't want this presentation to go over anyone's head, so I'm not looking to get you all involved in the CPA world. I really just want to give you enough information to make you dangerous. Ask the right questions to your own CPA. Think about what you're doing in your breweries that might apply to these certain tax credits, because you know what you're doing on a daily basis more than even your CPA does, certainly. So to be able to have those conversations, make sure you're asking the right questions and giving the right information. So the first one I'm going to talk about is the R&D tax credit. So I was born in 1980. The R&D tax credit was born in 1981. So it's been around for a long time, but it's really underutilized in a lot of different industries. And a lot of people think, you know, I need a scientist on staff in order to take advantage of this R&D tax credit. Couldn't be further from the truth. I guarantee everyone in here is doing R&D of some type in their brewery. And I was joking with a couple of coworkers who are accountants. Sam, I don't know if anyone picked up, mentioned R&D tax credits, or mentioned R&D in his speech 5 times. Maybe I was the only one that heard him talking about tax credits, but that's something that you guys are doing on a daily basis. You know, you're thinking of new recipes, you're thinking of a new way of doing things, you're thinking of a new way of canning lines, et cetera, et cetera. So when you're thinking about that, also be thinking about what time am I spending and how could I take advantage of this in my tax return? So backing up, the formal definition is it's a tax credit that's available to all industries for developing new or improved business components that result in a new or improved functionality, performance, reliability, or quality. So the definition of a business component, it includes products, processes, techniques, formulas, or invention. The 4 criteria that you need to meet for the R&D tax credit: technical uncertainty. So the activity is performed to eliminate technical uncertainty about a product or process to improve the product. So really you're eliminating the uncertainty related to this product. You're trying to improve it. Takes place through experimentation, so looking at alternative ways to do things, a trial and error, simulation, modeling, so you're using some process to get to the activity. Technological in nature. I wasn't much of a chemistry student when I was in school. I'm not sure that everybody that goes into brewing thinks they're going to do as much chemistry as you really do, but that's the hard science that you're looking at, is that chemical experiment throughout the process. And it's for a qualified purpose. So the purpose of the activity must be to create a new or improved product or process. We're going to go through some examples on the next page, but I just want to get you thinking about what you're doing in your breweries that has to do with innovation and what time you're spending, what supplies you're utilizing to get to that. So how to claim the credit? A couple of ways. The historical ways on the tax return. So this is a non-refundable tax credit. So you don't get a refund if you don't pay tax, but you can carry forward the credit up to 20 years. So you've got to have taxable income to claim it on the return, but that can be carried forward to offset future taxable income. For a startup, there's different rules, and this actually came about in 2017. So startups are defined in this tax credit as having gross receipts for less than 5 years, and you have less than 5 million of gross receipts in the year you're claiming the credit. And if you're claiming the credit, you can claim up to $250,000 on your payroll tax expenses, which if you have payroll, you have payroll tax. So even if you don't have taxable income, there's a way to claim this R&D tax credit through those payroll taxes. So these are just a couple of CPA examples of brewery R&D tax credits. So I'm sure that there's many more that you can think of what you're doing on a day-to-day basis. But just to get those juices flowing a little bit, changes to your filtration methodologies, the wastewater that you're doing, if you're doing something different with that or trying to improve the process related to that, different hopping techniques or styles, changes to your manufacturing technology to try to get more volume or a better diversity out of the product that you're producing. Changes to your packaging, so if you're looking to improve the shelf life or ensure the shelf life, changes to that. Biggest one, probably different recipes, different types of fermentation, dry hopping techniques, other types of fermentation, that kind of thing. So just think of what you're doing as a standard and what you're doing that's a little bit different, or trying to improve the process, trying to improve the product overall. So what expenses are deductible, or are eligible? Two main ones and then a third. The first one is wages, so we're looking at box 1, wages of the employee that is directly engaged in this qualified activity or is directly supervising that qualified activity. So think of your head brewers, your assistant brewers, if you're lucky enough to have an R&D brewer, looking for the production manager, if you have somebody working in the lab, that kind of a thing. So a lot of that time can be allocated to the R&D tax credit. So think of that time for them, as well as supplies. So any tangible supplies used in this process. Tangible does not include a capital expenditure. So if you bought a new piece of equipment and you're using it in R&D, if you think about that, that's going on your balance sheet. So you're capitalizing that and depreciating that, but that's not eligible within this expense. As with any accounting, documentation is really key here. So I would back up and go through those 4 criteria and write yourself a narrative. How are you meeting each one of these? And certainly reach out to your CPA to go ahead and document those. Document what supplies you're using, that sort of thing. I would also, you can really utilize this. I'm not looking necessarily for the brewers to be filling out a timesheet like a professional services organization does, so you can estimate that. You can say, my brewer's making beer for the test batch series 45% of the time. So we can allocate his time for using that. Maybe you know that your lab guy is always doing R&D, he's always testing quality, he's always doing that. So maybe you allocate 100% of his time to the R&D tax credit. So think of things like that. It doesn't have to be dollar for dollar. It certainly needs to be based on something that you can support for that estimation. So changes are coming. Actually, we're in the process of changing, if nothing else changes, which I feel like in this time of COVID, that's the only thing that is certain, is that there's going to be changes to the tax law. But back in 2017 with the Tax Cuts and Jobs Act, it was passed and it becomes effective 12/31/21, so it's effective right now, unless it gets changed. And this is saying that unless changed, companies are no longer able to take and expense all R&D tax. I'm sorry, let me back up. All R&D expenses. So let's say you've allocated $100,000 to your R&D. That made up of, some salaries, some of your supplies expense, blah, blah, blah. We have to capitalize that. So instead of saying you're going to expense $100,000 this year and take an expense on your tax return, you have to capitalize that, and you'll take $20,000 for the next 5 years. Does that make sense? Okay, excellent.
Yeah.
Oh, go ahead.
Are you, if this states in fact I guess years
Well, so this doesn't come into play until this year, so you wouldn't have to amend, like, the rules are changing effective the beginning of this year. So if, maybe I'm not, so number one, if you had expenses in, let's say, 2020 that you didn't take the tax credit for, yes, absolutely. Yes, you can amend for 3 years for just about anything. Yep.
Take a tax credit, you still take the expense as an operating?
Yes.
So you can double dip?
Yes. Yes, which you always get to do, but yes, the answer to that is yes. And that's why this is changing a little bit. So if you're calling $100,000 of expense R&D tax expense, you get you'll get a 20% of that deduction each year for the next 5 years, and you will get that tax credit. So the tax credit portion of that's not changing. It just depends on when you get to take those expenses. Yep.
And if the R&D is the creation of style or hopping techniques or these, whatever it may be, you can still sell that product?
Absolutely. Yep.
Sure with it?
Yeah, yeah. There's nothing that says in the R&D tax credit that A, your experiment has to work, or B, that it can't work. So you can sell that product if it worked, if it turned out, yeah, absolutely.
And what if it's actually taking smaller componentry hardware and building it into larger componentry hardware? Do you get to write off the portion of the actual smaller components, or is it just the labor associated?
I guess I would need to know what you mean by the smaller
Like if I
components.
was building a larger piece of equipment out of smaller pieces, would I be able to include the smaller pieces?
You're getting into a gray area there a little bit in terms, like, you would have to understand what your time is, like, what that experiment portion is. So certainly something to have a conversation about, but I think that needs to be a little bit more in depth than just a yes or no.
Kate, I just want to say that, and hopefully this is right, you'll tell me if I'm doing something wrong.
I certainly will.
But we basically, every time we do a limited release batch, which we do probably about 12 over the course of the year, we always track the very first brew, start to finish, and all the costs, and that goes on our R&D. And even though it's a scheduled program that we have, that first, we don't do it in the second batch, because my understanding is once you've done it once.
Yeah, unless you're changing something, unless you're, looking to improve that product further. So if you're making your flagship IPA, you're not going to take R&D against the time and supplies to make that. But if you have a test batch series, if you have a limited batch release, program, and you're making a new batch, or you're changing that recipe, changing that hopping technique, that qualifies. And that's certainly a conversation. Again, coming back to just make sure you're documenting it. Like, make sure you have something, because this is an audited area in the IRS if they ever catch up with everything else that they're doing. So this is certainly open, but I think as long as you have the narrative of what you're doing and a support for the expenses that you took, this is a legitimate credit. Yep.
Do you see any application, you said it was in all industries, do you see any application of this in like the tap room setting, as opposed to just the manufacturing of beer?
Potentially, yeah, potentially, if you're looking to improve a process or a technique in there, absolutely. Yeah, I mean, you could probably find a way to utilize this in just about every industry. I think it's underutilized because people think, you know, I need a chemist, I need a scientist, I need a lab guy to be able to substantiate this and to be doing this, and it's not true. You know, you're doing it on a daily basis. Yep.
So could you write off the purchase and then the time to train staff to the new software?
Potentially.
Oh, I like that.
Yeah, potentially. You just have to make sure that they fall within those 4 criteria. So if we can write a narrative that you're improving the process within those 4 criteria, you're trying to get to a better system in place, a better, you know, a better product at the end of the day, or a better process, then it could be R&D.
Just telling you to do whatever you want.
I'm not telling you that.
You can't prove it is what they got.
I am telling you to write a narrative about it. But no, I mean, absolutely everything isn't in there, but there's a lot of area in this that can be applied to an industry such as yours that has so much innovation, so much invention. The product is not always new. I mean, there's flagship, but there's, you know, people aren't necessarily coming to your tap room and drinking the exact same beer, and they don't want to be drinking the same beer. So if you can take a tax credit to invent the product that they want, that's fine. And to, I think, Rich's point, it doesn't necessarily need to be a new product overall. It's new to you. You know, you're not looking for the next New England IPA, you're looking for your next New England IPA. Does that make sense? You're not looking to reinvent a wheel. Okay. I think that's it for that. So FICA Tip Credit. Yes, okay, I'm on the same slide, sorry. So this is a credit that allows employers to take a credit against their federal income tax based on the amount of FICA and Medicare paid on tipped employees. So anybody that has a tap room will be eligible for this tip credit. I did give an example, just a little bit small, in terms of how this is calculated. I'll walk you through just a quick example. So my tap room operates a restaurant. I've got an employee. That employee during the month of May works 100 hours. I pay her a $400 wage, and in addition, she receives $800 in tips. So my tap room at the end of the day will be eligible for a $52 tip credit, and it's calculated as follows. The federal minimum wage amount is $5.15, and that's based on the 100 hours that she worked times the minimum wage when the tip credit was enacted. So that's $5.15 an hour. From that, we have to calculate the portion of the tips that's ineligible for the credit, and that's going to be the portion of the tips that bring the wages up to the minimum wage. So that's the $400 of what I paid her, bringing it up to the $5.15, which is the minimum amount. So that's ineligible. Everything else, eligible. So the $685 difference is eligible. And then the tip credit is based on the FICA on that number. So the FICA, the 7.65 times that number. So in this example, $52, which doesn't seem like a lot, although I do like this industry because I feel like every dollar counts. So $52 is nothing to, you know, shake your head at, but times 12, times how many employees you have, you know, this adds up to a decent amount. Overall, I think what I want you to take out of this slide is that your CPA should be asking for that credit information that comes from your payroll provider, paychecks, whatever. They're going to have a tip credit worksheet that you can just forward over. So if they're not asking this question, you're probably not getting this. I would look for this and ask the question of your payroll provider to provide to your CPA. Yep.
What if we pay more than the 5, whatever it is, in minimum wage for federal, like, if we pay almost $10 more than that?
Okay.
To our bartenders, like, how does that?
So then you're probably already getting you're already taking the expense because you're taking the payroll tax expense. You know what I mean? So they're just trying to even that out a little bit based on what those tips are bringing you up to. Anything else? Okay. never know which way to go. So the next one is the fuel tax credit. So the government taxes fuel via an excise tax to cover the cost of highway maintenance. This excise tax is paid at the time of purchase, and because it's not really feasible when we're standing at the pump, you know, trying to figure out like, I'm going to use it on the highway, so I should pay the excise tax. This guy's getting fuel for his warehouse, so he doesn't have to pay the excise tax. Everybody pays, and then the government lets you recoup the portion of the excise tax that is not being used on the highway. So it's 0.183 cents a gallon for each gallon purchased for off-highway use. It's claimed on the tax return. And I did point out, so again, keep your documentation. This makes the IRS Dirty Dozen list each year, which is not nearly as sexy as it sounds. So really just the areas of the IRS law that are fraudulent get exploited a lot, so they keep a very tight eye on this. So just make sure you're recording what those gallons are and proof that those were spent for non-highway use. Yep.
And that's just gasoline? That's not like propane for
I think it's just gasoline. Yeah, I can check for you on that, but I think it's just gas.
And when you say non-highway use, like what's a tangible example?
So if you had like a forklift that you're just running, you know, in your warehouse, so you're not necessarily, like, you're not putting those miles on the highway, so you're not incurring, like, they shouldn't be incurring expenses, like, that's ruining your floors, not the highway. Did you have a question?
Yeah, that's just like what is designated by the highway department, or like.
Yeah, so.
Maybe it's like super specific with your routes, and say like, oh, they drive only on like.
Yes, so that, I think that is why it's on the Dirty Dozen list, because questions like that, like some people would probably interpret that as like, I'm not driving on your roads. I would tell you that if it's not within your like footprint, if you're not only in your warehouse, your production space, those would be considered highway usage, even if it's a private road. But I appreciate that question. Anything else? Okay. So the next one is the work opportunity tax credit. And so this is a federal tax credit. It's available to employers who invest in American job seekers who have consistently faced barriers to employment. So there's a targeted list that we'll go over in a minute. The credit is based on 40% of the first year qualified wages for a full-time employee as defined by 400 hours or more in that first year. Typically, qualified wages are the first 6,000, so that credit would be calculated as 2,400. But for certain qualified veterans group, certain veterans in the group, that qualified wages could be up to 24,000. So that would give you a $9,600 credit. And this is really by employee. So you hire one, it's not an annual credit, you get it once when you hire them. Program runs till the end of 2025 right now. And the targeted group, so formerly incarcerated, convicted of a felony, SSA recipients, veterans are very big in this group, so if you're hiring veterans, certainly keep that in mind as you're going through this process. Residents of empowerment zones, and there's a couple of those in New York State, so those are geographic regions, some in Syracuse, some in the New York City area, but those are defined as geographic regions. There's also rural renewable counties, which is a terrible word for me to say, but there are two of them in New York State, Clinton County and Montgomery County. So those, if your brewery is within those counties, if your employee lives within those counties, you may be eligible for this credit as well. So again, really just got to ask the question as you're going through the hiring process. I wouldn't necessarily hire someone just for this reason, but if you're going through and you found the right candidate and it falls within a targeted group, certainly look into this credit. Yep.
Is that retroactive in any way, if you've already hired a person or if recently?
I think you have to actually go through the process before, yeah, so, no,
You have to identify before you make an offer.
yeah.
But you can legally ask those questions and not be susceptible to some sort of confidentiality or anything else like that.
Just lead with the CPA credit, like I'm looking for the tax credit here. So now we're gonna go into some specific New York State credits. First one being the New York State investment tax credit. So this is a tax credit that is specific on purchases of qualified property under the ITC. What's the definition of qualified property? Tangible property, so equipment, depreciable, so you're capitalizing it, you're not expensing it, located in New York State, principally used by you to produce, manufacture, farming, to produce goods through manufacturing, farming, assembling, etc. Useful life of over 4 years. And just a caveat, so storage of material, you wouldn't necessarily think of that as being used to produce goods, but it is considered used to produce goods here. So if you're buying, you know, a specialized storage system, a rack for your tank, etc., that could be used within this ITC credit. This is the equipment can't be taken under an accelerated depreciation method. So to get into that just a little bit, just to make sure everybody understands that. So there are different methods that you can, you know, buy a new bright tank and write that whole thing off, 179 in the current year. If you write the whole thing off this year, it's not eligible for the ITC credit. But there is some play there, because if you have a loss, you know, you're taking 179, but that's really just being carried forward versus should you have taken the ITC credit. So something to have a conversation with about with your CPA if you're buying a lot of equipment. Calculation of that, 5% of the first 3.5 million, 4% above that. There is an additional caveat for this for some employee incentive credits if you're purchasing equipment and adding to the headcount of the brewery. So if those two things are coming into play, there may be a higher percentage on the table, so keep that in mind as well. Those two things usually go hand in hand. The manufacturing real property credit, again, if you're a manufacturer in New York State, same rules, you're manufacturing, producing, assembling, farming, etc. You're paying New York State real estate taxes, it's 20% of that amount paid. So again, if you own the property, you're paying the real estate tax, something to consider. The pass-through entity tax. I was joking with my coworkers that this is going to be the end of me this busy season, so I'm gonna try to be nice to this credit right now. The thing to keep in mind here is this is a credit that you can use if you're making money. You wouldn't want to take advantage of this if you're not paying tax. I'm going to break it down a little bit for you. So most of you are probably either a partnership or an S-corp. You're getting a K-1 out of the brewery at the end of the day. You're paying that tax on the income from the brewery via your individual income tax. In New York State, and in every state in 2017, they limited your SALT, which is your state and local taxes, to 10 grand. So whereas if you were paying, 50 grand in your real estate taxes, your house taxes, your business taxes that you're paying from the K-1 income, et cetera, you were able to take that as a deduction on your federal tax return if you itemized. That number is now capped at 10 grand. So the higher tax states, the New York states, the Californias of the world, New Jersey, we're trying to figure out a way that we can pay the tax at the corporate level for the corporate income, and that's going to be outside of the 10 grand that you're taking on your individual tax return. So essentially, your brewery, if you make $10,000, you're going to pay 10% of a pass-through entity tax into New York State, and you're going to be able to take some deduction on your individual tax, and that 10 grand is going to be sitting in your New York State piggy bank as an estimated tax payment. Does that make any sense? Okay, excellent. I'm seeing some nods. I'm appreciating that. So again, really just keep that in mind. If you're making taxable income, if you're paying tax, you would want to opt into this. The opting in, don't tell your CPA that I'm telling you this, but you have to do it by Tuesday. So if they pick up the phone before now and Tuesday and you're making taxable income, certainly something to talk to them about. The election is made right through the New York State website, just how you pay your sales tax. But again, I wouldn't opt in unless it makes sense because you're paying tax and your partners are New York State residents that are capped at that 10 grand. Okay. Moving right along. I'd be remiss if I didn't talk about the alcoholic beverage tax credit. We've had a number of people that have not taken advantage of this, and quite frankly, your board has worked too hard at the lobbying efforts for this to get this excise tax back. It's 14 cents per gallon for the first 500,000 gallons, 4 cents after that. One thing to kind of keep in mind is that if your CPA is not asking you how much beer you make, it's not because they don't care, it's because they're not taking this tax credit. So they should be asking that question. If they're not asking that question, tell them, you know, this is the number of gallons that I'm producing, and this is how you're going to take advantage of it. Yep.
As a farm brewery, are we a registered distributor, or is that an actual distributor?
No, I think that counts. Yeah, that counts. You could take advantage of this. Yep. Anything else? Okay. Oh, excellent. Okay, so then the last item that I really wanted to talk to before we get into too many questions is the retention credit. And I know there's been a lot of questions. People have taken this throughout 2021. Some people have gotten the money back. Some people, probably more people, are waiting for the money to come back if you've applied for this. Even more people are probably eligible to take this tax credit and haven't. So I'm going to walk you through kind of the 2021 program. We're going to look, did you have a question? Oh, okay. We're going to look a little bit at what was available in 2020. We'll talk about 2021, and then we'll talk about how you would apply for this. So the 2021 version was signed into law in December of 2020. It increased the available tax credit to $21,000. So next slide kind of gives a little more detail. So this kind of compares the two. So under the 2020 rules, it was 50% of the first eligible $10,000 of wages coming down to a tax credit of $5 grand. 2021 came about, it's the first 70% of eligible wages per quarter. So that's where we're going from $5 grand 2020 to $21,000 2021. That says 2 quarters, but it should say 3 quarters. Eligible employees that are carrying on a trade or business in 2021 that have either a full or partially suspended operations due to government orders, or the easiest rule is 20% of your revenue went down. So that's a quarter by quarter comparison. And we're talking specifically here for employees that are considered small employees, small employers, and that definition in 2020 was less than 100 employees. 2021, that jumped up to 500 employees. So much richer credit in 2021 versus 2020, but again, if you qualified in 2020, not necessarily something that you don't want to go back and get for $5 grand per person. The last point here is really the biggest point. Oh, go ahead.
If you qualify for the IRS, can you go into this? Can you get this? I thought I read somewhere that if you got money from the IRS, you weren't eligible for this.
You are not eligible to take, you can't use the same wages. Yeah, we'll get into that because that's a rule that comes into play for all of these COVID-related, all of these COVID-related fundings.
That was my question. The
Yeah.
same thing applies to PPP.
As it applies to everything. So if you take your microphone's gonna be the end of me. If you take, we'll get into it, but if you take a certain amount of wages for your brewers week 1, you can't take that in R&D. You can't take that in the PPP. You can't take that for the workers' credit. Like no other federal program can. They're not letting you double dip in terms of that. So if you're taking it for the retention credit, if you took all the wages for the PPP, then you're not allowed to take it for this. And that's really the last point here. That's why it was underutilized in 2020, because before December of 2020, people were told if you got the PPP loan, you can't take the retention credit. And then in December, they came out with, well, you can, you just can't take it on the same wages. So if you think about it, if you're taking, you know, employee A's wages on the PPP application for week 1, you can't take it on this, but week 2, if you didn't need it for the forgiveness application, you can take it on this, you know, so.
My advice would be do not use your RRF for anything payroll related. There's plenty of other expenses. Keep
Yeah,
payroll.
and that's a big play. I mean, that's certainly a conversation that has to take place. There's also people that have put, you know, it's too late now, but we had a lot of clients that were saying, you know, I've got $1 million to put on my PPP application. I'm going to put 100% on wages because I know that's going to be forgiven. Well, now this is off the table, you know, so there wasn't a tremendous amount of guidance on how these two were going to play until the beginning of 2021. So the process for the retention credit. So first determine your eligibility, then you want to quantify what that credit is, and then you're going to claim the credit. So the determination for an eligible employer, and this is a gray area, so I will tell you to talk to someone about this because there's about 300 frequently asked questions on the IRS website, many of which are helpful, many of which are long and lengthy. And there's a lot of service providers that have analyzed those questions so that people in this room don't have to. They know what they're talking about. So I would start with your CPA, start with your payroll provider. They'll know the answers to this, but there's a lot of gray area that's being addressed. So in terms of suspensive operations, so the questions to consider, workplace closure. Was all or part of your workplace closed for a reason by government order? So this can't be, you know, people aren't coming into my tap room, so I closed early. This has to be mandated by a government order. Direct supervision, suspension of any operation, elements of your operations could be impacted. So a nominal 10% of your business could be affected, and you may have what's qualifying under the suspense of operations. Restricted operations, so you're restricted in terms of hours, you're restricted in terms of you have to figure out how to space out the tables 6 feet apart, you're restricted in terms of the number of people you could let sit at your bar, you're restricted by a government order, or suspension of a supplier or buyers, again, because of government order. The easier way, and probably the way a lot of people qualified initially, is the 20% rule. So if your gross receipts went down 20% quarter over quarter, you automatically made it. So none of the gray area of was my business affected more than nominally, was I suspended by a government order, et cetera, et cetera. If you met it for 20%, your revenue went down, then that was probably the easiest way. There's also a look back calculation, so if you don't meet it 20% quarter over quarter in Q1, we can look back to the prior Q4s. Does that make sense? So if you made it under the standard rule, you most likely made it in the next quarter under the look back rule because you're comparing the same thing. So then I wanted to talk a little bit about, and we talked a little bit about this, so what are the qualified wages? And I'm going to specifically talk about qualified wages for small employers. which by definition is less than 100 employees in 2020 or less than 500 employees in 2021. And that is all wages. So all wages qualify, but again, you can't double dip. So if you have you took advantage of the work opportunity credit, you took advantage of the R&D tax credit, you took advantage of those wages on the PPP loan, all of that is sort of off the table. So we're looking at what are those qualified wages that are left that did not get picked up or covered by another government funding program. Does that make sense? Yep.
And you take the tip credit on those wages and this credit.
Yes, yes, yep. They also have, and I pointed this out specifically for this industry because I know there's a lot of, family involvement, so they have specifically called out eligible wages of qualified family members, and there's a laundry list, but brothers, sisters, mothers, fathers that are helping you out in the brewery, those wages are specifically called out and excluded as well. So it's certainly something to keep in mind with this credit. So, go ahead.
Certainly a lot of businesses are family members.
Yep.
Is this only if they were brought during those years, or if they've been employed?
For the retention credit, if they're a family member, they're excluded.
Okay.
Yeah, so, there's nothing saying you can't hire them, there's nothing saying you can't take that as an expense, you just can't take the retention credit against those. Yeah. So at this point, the only method to reclaim the retention credit is to file an amended 941, which is the payroll tax return. There was a period in 2021 where you could get an advance payment, you could offset those credits that you were paying forward, but because the program's over and has not been renewed, although there's talk of it being renewed, that the only course of action we really have is to amend the 941. So statute of limitations for the 941, you can amend for the next 3 years. So certainly something to keep in mind, looking at if you have wages that are left on the table from other programs. The one thing that I will point out related to this, and this is a bit of a timing issue, is that this credit is not non-taxable. So the PPP loan is non-taxable. You didn't claim that as income, you're not offsetting any expenses with that, non-taxable. This is actually offsetting the expense. So let's say you had $100,000 of payroll tax, of payroll that you're going to use for the retention credit. That $100,000 cannot be counted as an expense during 2021. So that's going to lower your expense number. It's going to increase your net income number, your taxable net income, and you're going to end up paying tax on that number, which isn't a problem necessarily, except for right now, you're going to pay tax on that number in 2021 because you're filing your tax return right now, and there's no guarantee, because we're talking about government funding, that that money's going to come to you. So there may be situations where you apply for this and you get denied for whatever reason. We haven't seen, anything coming through an audit or, challenges, but the money's not necessarily in your bank account, and I don't necessarily believe it's going to be there until it is there. So you're going to be paying tax or lowering your carry forward, your loss carry forward by this amount. So keep that in mind and know that if you take advantage of this, we're going to lower that expense number, but there may be a need to go back and amend the tax return if you don't end up getting this money. So if you, go ahead.
Why would it, as it's a tax credit, so it's not funded like the PPP or the RRF, why would you feel that you wouldn't get the money? If it's tax law, it's a refund like any other refund.
The only reason I would feel that is because it's not in your bank account right now. and it's taking forever to get there. So.
I don't disagree that
Yes,
that's 18 months.
you should get it. There shouldn't be a reason for that. But that's something I would keep in mind, is that there is going to be a timing difference between I've paid out these wages, I'm gonna get this tax credit money, but I'm also decreasing the expense I'm taking. So if I don't get that money, I need to go back and take advantage of the full expense amount
Sure.
to amend the tax return.
Because I did a lot of this with my job at US Foods, we called it like the Wimpy and the hamburger. I'd gladly pay you Tuesday for a hamburger today. I'd gladly give you a tax credit 18 months from now.
Yes.
As long as you pay the taxes on that tax credit
Exactly.
today while you bought.
Exactly. Yeah, so at this point, I'm thinking that everybody's just wondering, what do I do now? How can you help me? So I would start, number one, with either your payroll company or your CPA. So those are probably the two lines of defense to make sure that you're taking advantage of this, and that if you have money left on the table, that you can file those amended 941s to get the money back. I will also say that have been certain circumstances for our clients that we've utilized or sent, those vendors that are in this space just for these one-off credits, just for the retention credit. And they can provide you with an auditor package that's going to stand up in court. And they're going to say, you're going to get $100,000 on your 941. That's what we're amending for. We're going to charge you 25% a fee, and you're going to get 75%, and you pay me when you get it. So if that's attractive to the brewery, because you're not out any money, you're not paying a CPA fee to do that, and they're saying we only get paid when you get paid, that's an option as well. You're getting 75% of something versus 0% of nothing. So something to consider, but there's a lot of options out there. I would certainly start with your CPA first. Your payroll company are very in tune to this rule and whether you would be eligible for it. But again, I would dare say everybody in this room has been affected by a government mandate, at least for the first 2 quarters of 2021, if not for that 3rd quarter. So keep that in mind. Yeah.
Can I make a comment? I think that's really important, is that, just so you all know, the governor put capacity restrictions in place in March of 2020, and it was not fully lifted until, I think it was June 21st of 2021. So it's an or statement, you can be up in volume and still get this tax credit. So, you should talk to your accountant. If you have, for those of you just doing production, and you don't have an inside space that was suspended on a capacity restriction, partially suspended, you may have trouble qualifying for it. But anybody who's got a tap room, where that tap room is more than 10% of your revenue, you should call your accountant and make sure you're taking advantage of this. The other thing is, if you haven't done your PPP2 forgiveness yet, there might be some of you who haven't done it yet, think about how you do that. The more payroll you spend on that PPP2 forgiveness, that's less payroll that you can use towards this tax credit. So ideally, you want to get it all forgiven, which means you have to use at least 60%. I would challenge you to find a reason why you want to use more than 60% of the PPP loan getting forgiven by payroll, as opposed to other expenses, because you're giving up 70% or whatever those dollars are.
We went through that. We actually did that, and because we're actually working with the company as well. But it was a challenge. The only, not that it can't be done, but the number of hours that it took me to look at, what the eligible other expenses beyond payroll were. I had to then locate, copy, upload. We got our PP loan through Bank of America, but copy, upload every invoice for every month, every payment, and confirmation of payment for every invoice for every month. My file was, 6 inches thick of stuff that ultimately had to be uploaded to support those non-payroll expenses. But we did that for that very reason, to maximize our PRC.
Yeah, I think, so during the PPP1, I feel like that was a missed opportunity, because in your situation, if you didn't know, and nobody did, everybody was saying, I can either upload a year-to-date payroll register, or I can upload 75 invoices. Like, what am I gonna do? I'm obviously gonna say, just take payroll, I'll take 100% of the payroll. But then, when they realize that we could interplay these at the end of December, when they pass that, now we're missing out on that opportunity. And you can't amend your forgiveness application, so those are off the table. So, to your point, that's a great point. If you haven't fully, if you haven't applied for forgiveness of that round 2, certainly something to keep in mind.
And don't think that the banks have your best interest in mind. The banks want the PPP off their books and forgiven.
Yep.
And the easiest, quickest way for you to do that is to use payroll. But I'm not saying that they're doing it nefariously. I'm just saying that what might be in your best interest is to talk to the CPA before the bank.
Absolutely.
And the CPA. I will say this too, and this is just opinion. I worry about those services because you want to make sure that there's a CPA behind there. Using a CPA for these calculations insulates you from a lot of liability with the IRS. So if you're going to use one of these firms, I would say do that. And if I had $100,000, I personally will tell you that my ERC for the 2 years was more than the PPPs combined. So it's a lot. It's hundreds of thousands of dollars for many of you in this room. That if you're willing to give up 20 to 25%, that you're probably going to pay more than having a CPA, even the CPA themselves at their hourly rate to calculate, which you're just going to spend a little bit more with those. I'm not saying you shouldn't do it, you shouldn't look at it, especially if you don't have the cash flow to pay that CPA now for this credit that you're going to see in 12 to 18 months. It might be the right way to go, but you're going to more than likely pay a little bit more.
Yeah,
with those firms.
and to your point, I would start with your CPA. We work with a company that will provide an audit package, and will stand up in court for you. That's what I would look for, because that's what you're going to get from a CPA. That's what you should be looking for from if you're going to use a vendor to do this. Is number one, maybe I don't have to pay you right away. That would be great. But number two, when this gets challenged, because it's not really an if, at some point everything gets challenged. When this gets challenged, are you going to have my back? And if that credit gets reduced, are you going to take a haircut too? That's the question.
And don't be afraid to use a different CPA than your current CPA.
Yeah.
There's a lot of good CPAs out there. Don't have the time, don't fully understand all of the details in this. I've had a lot of CPAs that dealt with a lot of customers, brewers and non-brewers, that I said, hey, you got a good CPA here. He or she just can't, doesn't want, doesn't have the time. They make a lot of money off of doing all of these other things. It's okay to go to a different CPA firm, get it done for a fee, and then obviously implement it with your current CPA. We saw that a lot, whether it's an outside firm, like you said, that makes it a fee, or it's just another accounting firm. Ask your fellow breweries, fellow restaurant owners, whatever it is, who they use.
Absolutely.
We got about 10 minutes.
Okay, so I think that's it. I just wanted to open it up for questions if anybody has any. Didn't come through the presentation. Okay, I think this was great. I love the interaction. And if anybody has any questions that they want to ask offline, feel free to stop by.
Thanks, Kate.